Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpeter, and every week I sit down with people shaping the world of acquisitions, founders who cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Today's guest is Arash Farin. He is the founder and CEO of Centerstone Capital. Before launching Centerstone, Arash spent nearly 15 years at the Sage Group and previously held roles at places like Goldman Sachs, Blackstone, and Lehman Brothers, really experiences that shaped founder-led exits as well as complex strategic deals. He's known for hands-on client work and building up high-performance deal teams. Centerstone is a merchant bank that advises on M&A, private placements, secondary transactions, debt, and IPO advisory. And they focus on 5 core industries: consumer, business and consumer services, technology, media, sports, entertainment, and healthcare. And the typical transaction size is between $100 million and $2 billion. I'm really excited to dig into the conversation with Arash and hope you enjoy what he has to say. Arash, last time I saw you, we were doing CrossFit with the CrossFit CEO in New York. I think I still might be sore, but hopefully that's soreness is worn off for you.
I'm still a little bit sore too, but I think you're sore because you did a better job than everyone else.
Unlikely. Well, I've really been looking forward to this one. I appreciate you making time. I want to dive right in. What you guys do at Centerstone is really interesting because you've got all these different sizes of transaction. Your career really spans all of these founder-led exits, these buy-side things with strategics. How does the nature of a deal change when the transaction is $100 million versus $1 billion plus?
Yeah, good question. I mean, I think there are a lot of things that are similar. I think the amount of work that you do is fairly similar. The process itself, the mechanics are pretty similar. Obviously, when you got more capital at stake, I think there's going to be a little bit more scrutiny on the part of the buyer, whether it's private equity or strategic. I think you're going to probably need a lot more debt to get that deal done. So getting the lenders involved and getting them comfortable and making sure they're ready to go and thinking about how that affects the overall transaction. I think that's going to be another important element. You may have other legal considerations, regulatory considerations like HSR, Hart-Scott-Rodino, where you need to get the government to approve certain mergers to take place. And then this is a little bit independent of size, but if it's a foreign acquisition of a U.S. entity, then you have things like CFIUS, where you have to get approval for a foreign buyer to come in. And I think the higher the value of the deal, it's going to be a little more scrutiny from the government to make sure that that we want our U.S. assets in the hands of the right foreign buyers.
Sure, and that's been something that's been in the news a lot recently. Just as you think about, foreign companies owning strategic assets in the U.S., whether it be ports or things like that. What are the natural breakpoints in terms of deal scrutiny? I imagine it, to some extent it is around the amount of money, but it may be, whether it's cash or debt, like you were referring to. Where do you think philosophically where, acquirers are just like, yeah, no big deal, let's just run through it, versus, oh my gosh, this is going to be so involved? How does an acquirer think about the level of due diligence that they're going to do? Is it driven more by the amount of dollars that are at stake or where that capital is coming from?
I think there are a number of factors that go into that. First of all, if it's a strategic acquisition or a private equity acquisition. If it's a private equity acquisition, then you have a couple other decision trees or forks in the road, which is it a tuck-in acquisition or a platform acquisition? So I think strategics are usually thinking about, if they're a large public company, what are the earnings per share? Is this going to be accretive or dilutive to their earnings? Where's the white space? What's the management team? How can they exploit their existing infrastructure to maybe, if it's a CPG company, to leverage their networks and get that product distributed more broadly than maybe a company can on its own. And if it's a private equity acquisition, especially if it's a tuck-in acquisition, meaning it's the second or third or fourth acquisition after a platform, then I think they're thinking through the synergies. And they want to typically they use debt to acquire those businesses because they don't want to add more equity to the mix, since that the less equity they invest, the higher their IRRs. And I think what they're thinking about is, where can they cut costs? Can they merge some of the back office? Can they eliminate certain positions? And of course, how can that acquisition help their existing platform investment grow faster and really is there maybe some multiple arbitrage. So what you see is especially with you see it in healthcare and in certain other consumer areas where you have mom and pop businesses and they're going to trade. They can be bought for, call it 3 to 7 times EBITDA. But as a large public company, you can trade for 12 plus times EBITDA. That's another key consideration that private equity firm is going to want to acquire as many of those small businesses as it can to become a nationwide leader and then probably go public at that higher multiple and benefit from that significant multiple arbitrage.
Makes sense. I guess a quick follow-on question is, let's suppose you've got two private equity funds that are doing deals. One is doing a deal for $10 million, another one's doing a deal for $2 billion. Will they go through that same level of calculus that you're talking about? Or is the $10 million deal just like, yeah, it's a smaller fund, smaller deal. It's not that big of a deal, even though it may represent a larger percentage of their funds they can deploy?
10 million is pretty small these days. 10 million is almost like it happens, in someone's sleep. I probably a more fair comparison would be maybe like, 50 to 100 million versus a couple billion. And I think for sure there's a major difference in how they get those approved, the investment committee discussions. I think if it's a larger acquisition, you're going to want to preview that with your partners and really spend a lot of time making sure that it's going to get through committee, because you also have to think about, a $2 billion acquisition, the third party diligence costs could be hundreds of thousands, if not 7 figures. Now, if it's a $10 million or $50 million acquisition, you're not going to have nearly the same kind of legal accounting and other third party fees. And so the last thing that a private equity firm, let's say, is going to want is to do a deal where they have all these dead deal costs and they have to eat it because they may lose the auction or because it doesn't get through committee. So there's definitely a risk reward balance where you want to make sure that if you're going to write that big of an equity check, that you're running through the traps and making sure that you're spending money wisely and that you have a good chance of winning and that it can get through committee.
Is it just the sense that are both companies in these examples doing the due diligence, and when you've got a larger figure, you want to pay more because you want a bigger logo to basically say, oh, this was looked at by XYZ consulting company? Or is there inherently more diligence that's happening at those higher levels?
There's definitely more diligence. I mean, we know private equity firms, they've got firms like Bain Capital or McKinsey on retainer, and they're, using very high priced labor to make sure that the acquisition makes sense. I think that on these smaller acquisitions, we know of companies that they're let's say there's a client we have now, they have about 100 million in sales, and they've already acquired like 10 to 15 other businesses in their sector. I think when you have that, it's more of a cookie cutter approach. You know what you're looking for, you know what price you should pay. It's either going to make sense, and you want to look out for any kind of legal issues like maybe litigation or things like that. But I think that it also depends on how many acquisitions they've done, because at some point it becomes so, if you're doing like a car wash roll up or, a landscape maintenance company or roofing or HVAC or things like that, that's been done over and over again, I think it becomes a little bit more routine and you kind of know the main things to look for. And so I think it also depends on the pace of acquisitions as well.
Okay. Kind of looking at it from a founder perspective, a lot of times people may think that they are a big deal or that their transaction is big, and it may be really big for what they've done. What is it that people underestimate in showing up as a big deal versus a smaller deal in the eyes of the acquirer?
Yeah, I mean, look, I think first of all, being a founder is very hard. I give a lot of credit to anyone who's done that and has built a nice business. It's definitely, you're a big deal for what you've done. So there's a lot of credit that goes there. But I think that where maybe certain founders get caught up or maybe have different visions is about the differentiation, about their business, about how commoditized it may be, what's the moat, the barriers to entry, and things like that. And I think that these days, especially if you're a CPG company, that level of differentiation, if you're a vitamin supplement brand, what is the scientific backing that you have, and how do you stand out? And so I think that is an area where a lot of companies, for example, there's this phrase we hear often, which is are you an Instagram brand? Are you a marketing brand? Or are you actually a real product? Meaning, are you able to get people to click through ads and get you to buy the product because you have very clever marketing? Or is the product driving the purchase, and does the brand really have significant value? So these are the kind of things where I think you need to think about what you bring to the market and how big of a deal you are. And what I think private equity in particular is going to push back on and really understand how replicable your business model may be.
Yeah, so I want to dig into those three examples that you shared. Which one do you want to be if you're a founder, if you could choose?
I think ideally you want to have both. I don't think life is not always a, bifurcation between two options. I think you have to have great marketing because that leads to great e-com KPIs. And that includes a return on your ad spend, repeat purchases, a high LTV to CAC, high lifetime revenue, things like that. But ultimately, if the product is not good, you're just not going to have a lot of repeat business and you won't last very long. I think some of the best companies out there, whether, the Allos, the Vioris, some of the other clients, we've had like Bombas and others, they have an amazing product, first off. And then the marketing is a supplement and a part of it. But if the product itself is not amazing, it doesn't matter. And you actually see this kind of playing out right now to some extent with Lululemon, where the founder had come back and said that the company had strayed away from its roots and the company had pushed back a lot and disagreed. But that's an example of the founder really being brand focused, being customer focused and product focused. And I think that's kind of playing itself out in the public markets in a very real way.
Yeah. So obviously, yes, you'd like to be all of the above, but it sounds like, these acquirers are going to go through and they're going to try to sort you, determine, are you product focused? Are you marketing focused? Are you influencer focused? What are some of the things that are a tell that say, oh yeah, this company is definitely product focused or they're definitely influencer focused?
Um, I think it comes down to the KPI. So we spend a lot of time, especially for our e-com companies, to identify what are the trends. You look at all the cohort data, look at all their Shopify data if they use Shopify, and you try to understand exactly what that's telling you about the company. One of the best operators I know, Sean Frank of Ridge, he said it best. It's sort of like the blood work of a company. That's why we spend so much time on that data, because it really defines what's a successful brand and what's not. And all those things I talked about, from lifetime revenue to repeat to the trends in average order value to the trends in CAC and all that, that's, I think, how you can determine if a company is just an amazing marketer and great at branding, or if the product really will stand the test of time. So those 10 to 15 benchmarks is, I think, the ultimate test to determine where they stand in that scale.
Makes sense. One of the things that was interesting as we were chatting before is that you do not only M&A work, but you also do private placements, secondaries, debt financings, IPOs, things like that. How does the preparation for a founder differ for each of those outcomes?
Yeah, we don't do IPOs. We help companies when they want to go public and advise them on that process. But I think from a founder's perspective, not all of those apply in the same way to a founder. The secondaries are where, let's say, a founder wants to give liquidity to its employees, and we help facilitate that process. If they maybe they want liquidity for themselves or they want liquidity for a shareholder, we help bring in a family office or hire with the individual to make that happen. I would say that a capital raise and an M&A transaction is fairly similar in the kind of work that's required. But a secondary is a little bit different. That's a little bit more of a shorter time frame. The materials required are less comprehensive, and it's just an easier deal to get done. The other things, you mentioned like a debt financing. That's also fairly straightforward, where we will work with a company and put them in front of a number of lenders, but typically that's not as involved. So if you think about it as a scale, I would say that the M&A process is probably the most intensive, the most difficult, time-sensitive, and time-intensive type operation. And the other side, I'd say, a secondary, maybe a debt refinance, that's probably a little bit easier to get done.
Gotcha. And when it comes to these secondaries in particular, what are some of the most misunderstood aspects of secondaries? I mean, I've seen them used as a liquidity tool, as you mentioned, but I've also seen them as kind of a strategic reset. I know we did a podcast deep dive on Roan, and I don't know if you know that story pretty well, but they basically
Yeah.
took on VC dollars and then said, hey, actually, what we want and what our VCs want are different. Let's go out and give them liquidity and kind of reset the cap table. So how should people think about these secondaries as a tool? Is it really just a liquidity play, or is there something more you can use?
I think Roan ended up buying back their equity from the private equity firm.
Right.
And I think they just want to have control. And you're right. Sometimes there's a divergence of opinion between the founder and the institutional investor. Mary Ruth Organics did the same thing. Butterfly had been their investor, and they bought their stake back from Butterfly as well. So you see that every now and then. I think that some of the other reasons beyond liquidity is really, as we were talking about, having greater autonomy over your future, having maybe wanting to, maybe you see more upside than the private equity firm does, and you want to maintain that for yourself, maybe prior to going public or prior to a second sale. The other thing I'd say is sometimes the private equity firm needs liquidity. It may not just be liquid, it may not be your side, because PE firms typically want to sell their assets within 5 to 7 years and move on to the next buy, the next acquisition. And so you may not want to be pushed into making short-term decisions with a private equity firm on board. And so that may also guide a secondary sale. There's a bunch of other reasons. I mean, there's a trend around continuation vehicles where a private equity firm will put the asset into another vehicle with a different shareholder base, because they also need to give liquidity to their LPs. And so you see that, and that's become a major force on Wall Street now. Those are probably some of the main things the reasons why we see behind secondary sales.
Okay. And private placements has been something that I've heard more and more about over the last couple of years. Where is this phenomenon coming from? Is it something that has always been around and it's now just getting its day in the spotlight, or is it becoming more popular for different reasons?
I think it's been around for a while, but actually today, interestingly, this morning, Morgan Stanley announced that it's buying EquityZen. And EquityZen, especially during COVID, was probably the premier firm to offer pre-IPO shares to retail investors. And the markets were going crazy during COVID, as you know. A lot of e-com companies and others did very well. And EquityZen took off because everybody wanted a piece of all these companies like Ripple and so many others. And I think it's still a big part. If you have access to the SpaceXs and Andurils and OpenAIs and all that, you're going to make a lot of money. So I think that the private placement world has not gone away. I think there was a little bit of dip the last few years because 2021 was a watershed year with a record number of mergers and acquisitions. And then things kind of dipped for a few years, but the desire never really went away. Now I think, now you have OpenAI, which is a $500 billion company, and you have so many other companies that are able to stay private for much longer. And so I think there's a greater desire by family offices who control trillions of assets and high net worth individuals and retail investors, right? Now they want to get in the game, and they want to not just invest in public markets, but they want to be part of alternatives, which is why the laws are changing around getting retail investors access to their 401ks, access to alternative investments. That's another big trend I think is related to what's happening with private placement. So it's all, I think, speaks to a desire to diversify retail assets beyond just a typical stock bond formula and into other asset classes like alternatives.
Yeah, it's interesting because I've seen stuff, I'm sure you have as well, where just the number of companies that are listed publicly has been going down for the last couple of decades. And so there's fewer available companies in the major indices that we typically point to say, oh, that's the stock market, that's the economy, even though we all know it's not the economy. Do you find that these private placements are becoming kind of a secondary stock market, if you will, its own entity class that is going to be has its own rules, or is this really just a stepping stone for these companies eventually becoming public and joining those other peers?
I think it's more the latter. I'm not sure they need their own rules. I mean, clearly you need to make sure that there's qualified investors, that no one's getting fleeced, and there's proper information flow and things like that. But I think that there's a record amount of dry powder out there, and I think there's going to be continued demand for private placements. But I don't know that there is kind of some warning signs. I think the only one I can think of is what I've seen is there's some trend around SPVs that own ownership in another SPV, and you're not directly on the cap table, so it's harder to understand what you own, and there's some opacity there. But that's really the only thing I think that may need to get looked at. I think it's more the latter of what you're talking about, where you invest in these companies as a precursor to a massive IPO or next round.
Got it. So if we were to fast forward maybe 10 or 15 years, maybe it's a world where you do have maybe some angel investors, maybe some seed stage funds that are getting companies off the ground. And then once they've hit a certain scale, but they're not quite ready for that large transaction, that's where the private placements will come into play. And it'll be almost like a form of growth capital. Is that the way to think about it?
Yeah, or just like even like a gift. I mean, there was a trend when the markets like in the leading into 2021, where you had a lot of companies like Wellington and Fidelity and others that were putting massive amounts of money. Coatue was like a crossover fund. They were also putting a lot of money in these pre-IPO companies, and so I think you'll see a resurgence of that because that was a super hot topic in the last run up in the markets, and I think that's going to come back as well. So I think private placements are going to be much more common, and there's going to be more marketplaces where like equities in where you can go and acquire these assets and own a piece of a private company because it's good for the shareholders, it's good for the founders, it's good for the employees, and it gives retail investors the ability to be a part of that journey as well.
Yeah. How do you find valuations are with these private placements versus VC? And I know one of the critiques that you'll hear with typical venture rounds is that, if I am bringing in another venture round or I'm bringing in another fund, I want to keep that valuation high so I don't have to mark to market or anything like that. Do you find that these private placement valuations follow those priced rounds, or are they more in line with what you might expect in the public?
I think there's a divergence because the private companies, especially because there's an illiquidity discount, they're not going to have the same public market valuations. And if they did, there's no reason to invest in them because you're not going to get a pop when they go public. So I think you're likely to have a gap between the private and public market valuations. And I think, a lot of times the problem is a lot of these private placements, you don't have any information. So you're really banking on the pizzazz and the reputation and the what you hear in the markets from friends and Reddit websites, things like that. So the problem is valuations go up a lot, but then you really don't know the financials and the underlying assets. And so you're kind of flying blind, but investors are willing to take that risk. There's going to be, there's always going to be some that don't make it, but that's kind of a lot of what you're seeing right now. And these companies doing private placements, they don't need to share information. They can just bank on their status as sort of the unicorns of the darlings of the industry.
Yeah. So let's kind of, this has all been very interesting to me. Let's put in some real world practice. Let's suppose I'm a founder, I'm doing a couple $100 million in revenue, and I've got all of these options at my disposal. How would you walk me through the decision tree in terms of what I should look at, what I shouldn't do, what's the right stage for me right now?
I think the first thing is understand what is your goal, what are you solving for, and what is the purpose of that capital and why and how much of it you need. Because I think that a lot of times we still live in a society where how much capital you raise is kind of a way to brag about your company.
Yeah.
But what people don't realize is the opposite is actually much more important, which is the least amount of money you raise shows the strength of that company. Bombas didn't raise a lot of money when they were looking to do a private equity sale, and Moise, when he sold Native, I don't think he took any outside capital. I think it was all bootstrapped, and I think that's really what's going to make the difference. And I think not just raising capital because it's there, because it's available, because it's cheap, which is not so much the case now, but raising capital because you actually need it, because it fits your master plan. And you're, by the way, not just getting um, commoditized dollars, but you're getting value add services. You're getting people on the board and people who can help you advance your mission. So I think it's really important to think strategically first about how much you need and whether you actually need it. I know some founders believe you always need to be in fundraising mode, and if there's money out there, you should take it. And of course, if you can get a valuation that's nosebleed status, then that's the exception. But I really think that so many people raise money when they don't really need it, just so they can have, the press release and the brag rights. But ultimately, I mean, put it this way: I know a number of companies that have raised money at super high valuations, and now their valuations are significantly lower, and they would have been better off probably being more conservative at the spigot and not going for all those headlines and massive valuations when the company's underlying financials do not back that up. And now they're in a bit of a jam because they can't raise money. They have to do a massive down round, and that doesn't feel so good.
No. Well, I think there was also this whole class of founders, maybe 10 years ago, where it was like, look, I'm going to raise a bunch of money and I'm going to get the highest valuation I can because I'm going to make my money personally on secondary, right? And so I'm not really interested in selling this company. Of course, obviously I want to, but if I can, sell my shares as quickly as possible, that's good for me. And that's really the game that I'm playing. I think that class has been basically wiped out. They're doing other things now. But I think it is, this difficult thing of you actually have to build a company that's worth buying, right? You've got to build something that's profitable, that has a unique edge, that's actually has something that someone else is going to want. And I guess I'm curious, from your perspective, how should a founder think about the right level or the right type of capital to raise?
Yeah, I think the first part of your point is very valid, especially right now, because with interest rates higher, with inflation where it is, with the lack of exits, buyers have become way more discerning. They're not going to just invest their money like they did in 2021 when money was cheap and you had SPAC mania, crypto mania, and people were just kind of handing out money like candy. Now you have to have a business that's differentiated, that's going to have, longevity value and staying power, and that's really the most critical element of any potential sale. I think that, and I think, you see in the kind of diligence questions that private equity firms ask, you look at how long deals take now to get done. So all this stuff is really playing itself out. So I think that really is an important element that founders need to focus on because the climate is very, very different today. It is, it's quite choppy. It's not always a seller's market, and there are a lot of bid ask spreads between what the seller, their expectations, what buyers are willing to pay, and that's making it hard to actually get deals over the finish line.
That's interesting. What's your perspective on leverage when you're advising a company? Is it better to not have any debt whatsoever when you're thinking about a transaction or things like that, or is having some level of leverage a sign of sophistication and maturity that actually bodes well when they're going out to market?
I wouldn't look at it quite like that. I'd say that leverage is important if you have the cash flow that paid off and it helps you with your working capital. I know businesses that need working capital because they have to, they need to stock up for a holiday season. They need to stock up for Father's Day or certain other seasonal businesses, and you have to have that ability to borrow in order to fund your inventory, to grow your sales. So I think if it's done well and it matches the business's overall trajectory, that's fine. But I don't think debt necessarily indicates sophistication. I know companies that have debt and they're not necessarily reflective of that. So the debt itself is more because it's a important necessity to grow your business. It's cheaper than equity and getting diluted, and you have a way to kind of borrow it without getting over your skis, without getting over levered. And it is intended to, help you reach that next level of growth where you think you're going to get to. And so there's some really good examples of that that we can talk about. But that's how I would think about it, not as a sign of sophistication.
Got it. Okay. That makes sense. And so, effectively debt is just borrowing time, right? Like you're saying, I've got this cash flow. I'm going to make $10,000 a month that's coming through here. I need $100,000 a month. So rather than waiting for 10 months, I'm just going to get all that up front. And then, maybe I'm paying $500 a month in interest and things like that. So that makes a lot of sense. And so it sounds like what you're saying is that it's much more important to have strong foundational cash flows, right? It's a profitability thing. And yes, you should probably have access to debt facilities, but you don't need to be using them necessarily if you don't have that big swing that you want to uh, invest in, whether it's a new product line or a new factory or things like that requires all of that cash up front. Do I have that right?
Yeah, I mean, I don't. I think most people are a bit smart that we've met in terms of how the debt that they take on. Sometimes you take on debt because you think there's going to be growth, and then you have a problem because the growth may not materialize. But yeah, I think the way you mentioned it makes a lot of sense. And there are so many options now for companies to go to for debt, whether it's venture debt, whether it's Shopify's financing, whether it's private credit opportunities and traditional bank debt. So the options are out there, but I think really thinking about why you need it, when you need it, and how much, that's really important.
Great. When you are talking to a company and they're looking for that exit, whether I'm sure there's a point in time where you're talking through and saying, well, maybe we should pursue an M&A. Perhaps, an IPO is the right thing for you. What are some of the decision criteria that would maybe push a executive team to lean, acquisition versus IPO?
Yeah, that's a good question. I mean, I think that I think that you got to look at it from both sides. From your perspective, IPOs are great in many ways. It gets you public exposure. You could stock to, pay your employees with. You may get, if you're large enough, you get equity research, and so people know about the company. And there are a lot of advantages. There are a lot of companies that probably shouldn't be public right now, especially like in e-commerce, because their market caps are 20, 30, or $200 million. And I think that's quite low for a public company. So I think an IPO can serve certain great milestones, but I think that a lot of people are being more careful, rightfully so, because you can be a private company and get a lot of the same benefits. And so I think from an acquisition perspective, one of the benefits of an IPO, maybe you get a better valuation in the public markets than you do in the private market. So that's another thing to consider. The other aspects of it could be, when you think of an acquisition, by the way, it may not be 100% acquisition, maybe a majority acquisition. So maybe you want to sell 70% to a private equity firm because the remaining 30% will be worth a lot more if you build that company with that private equity firm 5 years from now. And so those are a lot of the reasons why a lot of our clients will take on private equity money and they'll sell a majority stake today, 60, 70%. And then whatever cash they get, the remaining 30, 40% 5 years from now is worth more than the original 67% that they sold. So if you have a strong alignment with that private equity firm and you think they can help you get to the next stage, that's another reason why it may make sense to have a value add partner help you acquire your business versus going public. As you go public, you don't have a partner with you. Your partner is you now you have quarterly earnings and you have to report to shareholders, and that creates, first of all, you got Sarbanes-Oxley, and you have a lot of reporting requirements, which is both costly and very time consuming.
I think, we shouldn't minimize the impact of those quarterly reports, because if you are an independent company, you're doing well as a startup, you don't have to necessarily think about all those things. You can maybe make some longer term decisions or some more aggressive decisions than you normally have to. I wonder if you have any commentary in terms of just the whiplash that a company may feel if they are not used to, that dry run of quarterly reports or having the right fundamentals that are going to hold up in a market.
Yeah, I mean, I think that's a very common thing. I mean, I've heard, I think Trump had even talked about maybe removing quarterly earnings and having, earnings every 6 months so that companies have the ability to plan for the long term. That's, by the way, what the founder of Lululemon had brought up, which is he said in the quarterly, in your desire to kind of meet your quarterly estimates, you've kind of lost that long-term focus. So it's another thing that you see, a lot of companies being accused of. So I think that whiplash is pretty relevant, and especially because a lot of these companies have stock-based compensation, they have an incentive to try to boost the stock price because they want the options, to be worthwhile and for their employees to be paid. So it definitely, I think, does breed some short-term behavior that may not be in the best interest of long-term shareholders. Nordstrom just went private, right? They don't want to be in the limelight anymore. And so I think you're going to see more of that. Companies that are just tired of that whiplash and want to fix their company and operate in a more secluded, non-public environment.
Yeah. Do you have any advice for companies that are what could a company be doing today to start building that muscle memory prior to going public that will make them more successful?
Yeah, I mean, I think financial controls are really important. A lot of companies, as they get larger, they sometimes they kind of scrimp on the CFO role, the controller role, and I think making sure that your financial controls are there. Having discipline around some areas of your business, like your marketing spend, and getting back to the e-com KPIs, thinking through how effective is your marketing? What are the KPIs that matter? Are there guardrails around for your ROAS and your CAC and things like that govern your marketing spend? Making sure that there's alignment, there's a real vision that employees understand, that know where you're headed and where you're going, and the CEO communicates that vision very carefully. That the culture is kind of built to go public, because that also, obviously impose a lot of scrutiny on companies as well. So making sure the vision is aligned throughout the company, I think that's another thing. The other thing I would add is just management quality. A lot of companies, as you've seen, they bring on very talented board members and C-suite members right before they go public. So I think having really quality management on board. Bombas just replaced their CEO. Dave wanted to kind of do other things, and they brought a really talented guy there to do that for them. So the quality of the management team and the depth of that management team, that's also pretty important.
That's good. One of the things I think was interesting just in your background and what you do at Centerstone is you've got these 5 different sectors that you focus on. Everything from sports and media and entertainment to healthcare to consumer to technology and business and consumer services. I guess as you look at those core sectors, what are some of the universal things that buyers always care about regardless of the sector?
Yeah, I mean, look, I think solid financials, great revenue growth, great gross margins, good EBITDA, good cash flow, free cash flow, so that the amount of EBITDA doesn't always represent free cash flow. You've got to think about, is it a capital intensive business? Is there high CapEx? What are the working capital trends? I think all those matter. If you're healthcare, you may have other things like reimbursement risk and what is the flow of payments? What does that look like? I think a lot of things that are synonymous across these industries is, to what extent is that product or service necessary, or is it a discretionary item? I think consumer discretionary has been hit pretty hard because of high inflation and interest rates and, student debt and things like that. And so you see a lot of money going toward services businesses, or if it's consumer, they want enthusiast businesses, areas like automotive aftermarket, right, where people are nuts about their cars and they're going to spend money, or pets, where they're going to spend money no matter what. So I think the level of necessity about that service or product is also important today. And so that's why you see healthcare or SaaS that are continual winners, because you can't necessarily replace these companies. They're necessary in people's lives. And there's a high barrier to entry once you're a sticky customer base.
Yeah, that makes sense. I mean, the opposite end of that, I guess, what are some of the sharpest differences that you see in these consumers? I have to imagine that what a buyer evaluates in a healthcare transaction is very different than what a buyer evaluates in a consumer transaction. So what are those I guess, fault lines?
Well, healthcare is a pretty big area. I think it depends on what aspect of healthcare, but I think that in consumer, it's really about how differentiated you are. Whether it's an apparel company, whether it's beauty, whether it's vitamins and supplements, it's all about what is the moat around your business, what is the brand value, how differentiated you are, and to what extent can you be replicated. I know a lot of companies in consumer, they're getting hit by cheap Chinese knockoffs, and their ability to fight back and protect their IP. That's another important element. So those are some of the things that I think we see most often with consumer companies. And healthcare is such a broad, vast area, but it depends on what part of it. But I think also what we've seen a lot is this overlap between healthcare and consumer. So companies that are promoting sleep, companies that are promoting longevity, biohacking, fitness, things like that. I think there's this crossover between healthcare and consumer that I think has gotten really interesting, and a lot of capital is being flown or being directed toward those kind of companies as well.
That's interesting. I want to focus a little bit on media, sports, entertainment. I mean, these are things that often have like this halo effect. Like, I have no idea how you would value the Dodgers or an NFL franchise, but it's kind of whatever people decide they're worth is what they're worth. How do you help buyers and sellers bridge this gap between brand equity and hard financials?
I think when you talk about sports these days, it's really a seller's market. You can get almost any valuation you want.
Yeah.
The New York Giants just sold a small stake for 10.3 billion, which I think is the highest for any NFL team ever.
Wow. And it's the
And so I
Giants.
think in sport, yeah, exactly. And so that kind of gives you an idea of where everyone else is valued if they're valued at over $10 billion. But I think obviously media rights matter, the ticket sales, the food and beverage, parking, and some of these teams own their own arena, some of them don't. Some have the real estate around the arena. That's also pretty important, and so on. So I think that those are kind of that's what's driving a lot of the valuation. But I think the media rights for the most part have been the most important ingredient.
Gotcha. So it's still very much tied to the free cash flow, the fundamentals that you'd see. It's not just, well, it's worth $1 billion, but because it's the Dodgers, it's going to be worth $5 billion.
No, I mean, I think with the Lakers, I mean, look at what happened. Like the Celtics sold for $6 billion, and they're about as well known as any other team in a big market. And then the Lakers sold for $10 billion pretty soon thereafter. So that gives you an idea that if someone wants something really bad, two assets that are fairly similar in terms of championships and so on, can trade with a difference of $4 billion in a very short time span.
Yeah, I guess that's what I'm trying to get at, is how do you account for that $4 billion difference? Is it, were the Lakers that much more profitable and their portfolio that much stronger that it went there? Or was it just there was somebody who had $4 billion extra that said, I want the Lakers?
I think it's more the latter. I don't know the Celtics numbers or Lakers off the top of my head, but I think that was a matter of scarcity, and just the necessity to have it, and just abundant cash available for those kind of transactions. And you're lucky if you get one of those deals in a generation. And the Lakers obviously they never come up for sale. So I think it's much more the latter. I don't think you can really tie it to any kind of financial metric whatsoever.
Yeah. I always, you think back to the hubris of maybe 10 or 15 years ago. And I remember talking to founders who, were raising money and were playing startup, and they were just like, I'd ask them, like, so what is it that an acquirer is going to be interested in? Like, oh, the brand has all this value, and
Yeah.
they want to buy the brand. I mean, obviously, like, the Lakers are a brand, and this is in a league of its own. But how often do you see in non-sports elements that the brand actually matters something, where people are going to pay a stupid amount, maybe not billions of dollars, but more than what the market would look at just on their fundamentals?
I think it matters a lot. I mean, the brand, we talked a little bit about marketing companies versus product companies. And I think great product companies have built a great brand based on the quality of that product. So I think, Viore is a great example of that. Olive is a great example of that. Gymshark is a good example. Ridge, Bombas, all these companies. So I think those are companies that have amazing brand value way beyond the actual metrics that would tell you. So non-sports assets, it happens a lot. And those are a few examples of companies that have done it really, really well.
So I'd like to hear more about that, because there's kind of this question of, were these companies great brand or product companies first, and then that gave birth to the brand? Or was the brand strong enough that people said, yeah, the products are fine, there's other folks out there that are similar, but I prefer to go to, like, how do you actually know if you've got a brand that is going to command that kind of multiple? Because I feel like most founders think that their baby is the cutest, and they may, overestimate how much that brand resonates with the consumers. But what do you look at as an outsider and say, yeah, this is actually worth something?
Yeah, I mean, I think with companies like Bombas, for example, the two kind of went hand in hand right from the beginning. They had an amazing product. They spent 2 years to get it ready before they went to market. They made sure the product was exquisite. But the branding also, especially around the 1-for-1, where they gave a sock to the homeless for every pair you bought. That was part of their marketing right out of the gate. So I would say the two went very well together right from the beginning. And so I think they did a very good job of building a brand based on an amazing product and a mission that everybody could get behind. I think that, Ridge also has done an amazing job. They have an indestructible product. It's a lifetime guarantee. People love it. I think that, and they also have unbelievably good marketing because they're so talented. Connor, their CMO, is amazing. And Sean's got a great eye for marketing as well. So I think I would say that most companies, they don't just think of one, they don't sequence it where you have a great product and then the marketing comes next. I think you're constantly trying to optimize for both and doing it great right out of the gate. All the best companies we know, you don't have a company without great product. That's for sure. And I think you look at some podcasts, you look at some of the other founders, whether you look at Roan or Faherty or, some of these other companies, the product has to come first, but they're also smart enough to know that really skilled marketing has to be there right at the same time.
Yeah, it's an and sort of situation. Makes sense. I know that you were recently on the Operators podcast, and that's just a collection of really great aspirational brands that people look to, and there's a reason that their podcast is as successful as it is. If you were advising those types of companies, and they said, hey, but Arash, we're 3 to 5 years out from a potential exit, what are some things that you would be encouraging them to do right now to maximize their optionality between M&As or IPOs or some other transaction?
Yeah, I think it's similar to a question about, if you were going to do an IPO or, you want to get ready for that, what would you do? I think, first of all, getting your financial house in order. I think a lot of companies scrimp on the CFO side and the controller side, and making sure you have GAAP accounting, not cash accounting, and making sure you have a really good, your numbers are getting reviewed or audited, and you have a good accountant by your side. I think that's really important. I think the days of optimizing for revenue growth and no profitability are over. You have to have significant profitability to matter, and that is, generally a 10-ish% EBITDA margin, if not higher. I think the quality of your team is also super important, making sure you're upgrading at different milestones and making sure you get really talented folks who can, if you're a founder, you may not have run a $500 million company. And so bringing people from the outside who've done that before is also pretty important. The e-com KPIs we talked about multiple times. If you have an e-com business, which most do, I think other than that, making sure there's not a lot of concentration. So making sure that you don't have any supplier concentration. If you have China exposure, diversifying that away to Vietnam or Cambodia or Mexico or elsewhere. And then product concentration, making sure that you have diversity in the number of SKUs you sell, so you don't have any one or two hero SKUs that are changing, how people will think about your business, where they may say you're too concentrated in one or two areas, and that may give them some fright as well. So those are some of the things that we would focus on.
Yeah, that makes sense. I mean, I want to come back to the CFO piece because you mentioned that a couple of times now. What does it look like to not skimp on your CFO? Is it a matter of paying somebody a lot, or is it more about giving finance that's due and making sure those controls are in place?
Well, I think it's getting someone who is really qualified, who knows the numbers well, who can model well, and be proactive. I mean, I think the best CFOs are almost like co-CEOs. They're strategic thinkers and not just sort of people building Excel models and providing the numbers. I think it's also stepping back from it and explaining what you're doing and why it matters, and being strategic in your thinking. So I think that's kind of what I'm getting at, is not just having someone who's, a nerdy, numbers-oriented person who doesn't understand the strategic goals of the business, but somebody who can wear multiple hats, who can fill in for the CEO if necessary, who can also act as like a chief strategic officer if necessary. So it's kind of um, having that level of talent at that in that position.
Makes sense. Okay, so it's someone with equal decision making authority as the founder, so to speak, but just has a different context or background that's approaching problems from a different way. Is that a fair way to look at that?
Yeah. It's someone who can wear multiple hats. Who, if you need to fill in for the CEO, you can do that. It's you're not just kind of keeping the numbers, but you're understanding what they mean and
Hmm.
how do you take the company to the next level. Knowing whether you need to buy another company, whether you should grow organically. If you were to buy someone, who'd you want to buy and why? Just having that level of expanded talent, I think, is important.
Right. And so I think like the difference between a controller and a CFO in this definition is the controller is that person who's just keeping track of the numbers. The CFO is going a step beyond and saying, okay, here's our options, here's our trade-offs, here's what we could do.
Exactly. That's right. That's
Makes
right.
sense. With these other companies that may be 3 to 5 years out that are doing well, what are some of the most common mistakes that you see them make in the run up to a transaction or an IPO?
Um, it's sort of the opposite of what I've been talking about. So, not having great financials, not having gap accounting, having gaps in your management team, having SKU or vendor concentration, um, thinking about going to market when your financials have dipped, trying to go to market when it's not right for your company, your margins aren't where they need to be, but still want to get credit for that when the timing may not be right for that. Maybe you have too much China exposure and getting hit by tariffs, and so that's something that you need to kind of work out. You can have a good banker. A good banker will warn you about all the questions and all the issues with pitfalls that are likely to happen in the process, and not listening to the people who've done this so many times, thinking that you can kind of like charm someone when that doesn't always work. So those are probably some of the more common things. Um, no company's perfect. We always see minor things like labor issues pop up or, minor lawsuits, things like that. That doesn't really matter. It's more about the financials, the management team, concentration in certain areas, and thinking about your differentiation. We talk about that a lot because that's ultimately what it all comes down to.
Yeah, it makes a lot of sense. Well, Raj, I can't believe where the time has gone. I feel like we could talk for another couple hours. Maybe the next CrossFit session we'll just be in the corner talking about this stuff. But we've got two questions that we always love to ask our guests on Build a Business Worth Buying. And so I want to ask you the first one. What is the best example of a moat that you've seen a business build?
Probably OpenAI right now. I think OpenAI has got more users at a faster time frame. They have 800,000 users. They even beat Facebook in terms of how fast they grew.
Wow.
They've got every other company dependent on them, from Microsoft to Nvidia to data center companies and so on. And I think they've tied up so many other companies financially and contractually to need OpenAI for the future. I'd say it's probably the most, it's the largest company I can think of that's done it. But I think they have an unbelievable moat that's going to keep them ahead of everyone else.
That's awesome. And if you had to start today, how would you go about building a business worth buying?
Massive white space, not a lot of competition or saturation, a really differentiated product that can stand the test of time, a rock star management team that knows the vision and can execute on it, and people around you, other experts and building an advisory board who can guide your company in its growth trajectory and help you sort of execute in the most effective way possible.
Love it. Well, thank you so much. This was fantastic, and thank you all for tuning in. We'll have you next time on Build a Business Worth Buying.
Great. Thanks, Aaron. I appreciate it.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.